Just a quick reminder, this podcast may contain general advice, but it doesn't take into account your personal circumstances, needs, or objectives. The scenarios and stocks mentioned in this podcast are for illustrative purposes only and do not constitute a recommendation to buy, hold, or sell any financial products. Read the relevant PDS, assess whether that information is appropriate for you, and consider speaking to a financial advisor before making investment decisions. Past performance is no indicator of future performance.
Hello and welcome to episode 30 of Stocks Neat. I'm Steve Johnson, Chief Investment Officer here at Forager Funds. And today in the hot seat, we've got Harvey Migotti filling in for Gareth Brown, a regular fill-in guest for us on the podcast. How are you, Harvey?
I'm good, thanks. Yeah. And yourself?
Very well, thank you. Portfolio manager of our international fund, as I'm sure most listeners know, coming up to 5 years now with Forager, Harvey. I've had a lot of calls with investors over the past couple of months, just going through the delisting process for our Australian Shares Fund, and a few listeners to the podcast as well. And a number of people wanted me to pass on their thanks to you for the difference that you've made to their portfolio over the past 5 years and the changes that we've seen for that international fund of ours and the improvement in performance there and shaping up to be another really good financial year for the fund this year as well.
Well, touch wood, it continues. and thanks a lot. I appreciate it. Yeah.
But you've done really well. You like owning businesses that are in sectors that can grow and have got some tailwinds behind them. And, we've had a number of those work well for us, buying at times when people were less optimistic about it. Obviously, the theme that everyone's talking about now is artificial intelligence. It is very real in terms of the money that's being spent on the space out there. And you and I have just been talking prior to this podcast about some of the adjacencies, and I thought it was a really interesting insight into how you think about the world of investing and how the obvious theme is rarely the best investment.
Well, it's probably the best investment if you're very early, but by the time, it's starting to materialize and it's starting to come through numbers, you sometimes find that they've run away, but that there's many ways to make money off of one theme. And, this kind of AI data center build out, obviously semis and the AI semis have run, but, there's other companies that were first derivatives of that, such as Vertiv in the US, industrial company with, 70% of the revenues coming from data center cooling products. Very obvious in hindsight, but, their orders are growing 50, 60, 70% year on year. They're getting pricing. That stock's up 7x over the last year. So the opportunities were there. And we actually think there's a lot of them out there that are still somewhat flying under the radar. They're getting more recognized, I think, over the last month or two, but they're still under the radar. And that's just more to do with the power gen side and the transmission side and so forth. So, think about solar companies in the US or power generation companies, transmission companies, guys that supply cables for all this stuff, copper as a commodity, natural gas potentially as a commodity, because you need that energy. I mean, people are estimating that US energy demand needs to grow by 30% over the next kind of 7-8 years. 30%, yeah.
Just the impact of building out data centers.
It's not just data centers, but there is some baseline energy growth that should happen. The US has been stagnant for 20 years and you've been absorbing some of that capacity, but you're also, at the margin closing down things like coal plants and so forth as a result of that over recent years in the ESG push. So pockets like solar should outgrow that base number. Europe, I saw an estimate yesterday, I think it was from Goldman Sachs. Don't quote me on that though, but it was that demand there needs to grow 50%, and energy supply, needs to grow 50% to keep up with demand over the next decade. I mean, incredible numbers after the last 15 years where kind of energy savings and cost efficiencies have come through the system and lowered demand.
It's interesting, some of these adjacencies, it's almost less risky than most of the companies that are actually, I think there's still a lot of uncertainty about how much this is fundamentally going to change businesses and whether the amount of CapEx that even in some cases, large companies are spending on this is actually going to be a good return on that capital or not. A lot of that is unclear. But if you're the person that's the beneficiary of the capital spend itself, it seems like that is locked and loaded for the next 5 to 10 years, that there is going to need to be more capacity built.
In a gold rush, you kind of invest in the pickaxe manufacturers, so to speak, right? So we've kind of done that. I mean, we own Applied Materials in the semi-cap equipment space and a few other companies that I think we haven't disclosed, but in the solar space, so solar capacity and generation in the US and a few other areas. We definitely are long certain commodities, uranium, copper, through investment in Glencore and so forth. So,
do you have any views on taking the investment piece to one side, but just ways in which our life is likely to change over the next decade in practical ways because of the influence of artificial intelligence?
It's funny. I read this tweet and it actually resonated with me. It's like, I don't want bloody AI to come and do art for me and this kind of stuff. I want AI to come and clean my house and help me do laundry so I can do art. And that really kind of that resonated with me because I feel like there will be jobs out there that probably disappear to some extent because of this. I mean, you just think about the content that some of these systems are generating in terms of videos. You can just type a little script in and all of a sudden, wham, bam, you've got a little kids show, 5-minute, 10-minute episode of a bear and some bunnies, whatever shenanigans happening in the woods, or a new Tom and Jerry episode. And it's probably really, it's going to, or over 5-10 years, going to be something that these things can generate. So a bit scary for certain industries, I think, to some extent, potentially ours as well. But it's definitely going to make things more efficient. And I think you're already seeing that. I know another fund manager who was telling me that he writes his monthly and then he puts it through a ChatGPT.
Yeah.
And it gets it to spice it up and kind of make it sound better and, sometimes adds...
Change underperform to outperform.
I'm not sure it blatantly lies too much just yet, unless it's doing legal stuff, I heard. So that's definitely saving people time. And I mean, look, everyone's debating AI. I kind of don't want to sit here and put my 5 cents and 2 cents and whatever. There's no point. I think that parts of our lives will get harder as a result of it, and people might need to find other careers and paths, and that scares me. And on the other side, things should, in theory, get more efficient, but you still need to do your laundry, and you still need to do all that menial stuff. And that's, I'm looking forward 20, 30 years. That's when I really hope, some home robots like the little Roomba I have, that can actually save us stuff that we don't want to do. Yeah. Give us more time for the things we do. That's where I feel the real benefit would be for many people, I think.
And I think every single technological transformation that we've had, people have underestimated the amount of additional usage that it causes, the amount of additional supply of things. So everyone just thinks, well, it's going to take these jobs. They don't think that with the tool, a person can create 10 times as much content. And we are going to be inundated with content. The Economist had a piece in a recent issue of that where they took the video. So you can now, as you just touched on, there's ChatGPT video equivalents where you can go and say, make me a video of X, Y, and Z. And they went to 3 different marketing firms and said, we want you to test these 3 different video AI tools and tell us what you think of the output. And one of the responses there was, I had these 3 different campaigns. I got it to make me a video of them, and it's nowhere near the standard that I would actually use to run an ad. But could I take it to the client and say, I've got these 3 ideas, here's 1, 2, and 3. Yeah. You get the general gist of what we're trying to do here. He said, absolutely. And that was a week's work for us working on a pitch deck that's now 5 minutes. Okay, I've got a great idea, put it into the engine, get the engine to make me something rough. And then there's a lot of time that needs to be put into making that a professional ad that goes on TV. That will get better. But ultimately, they're going to be able to create dramatically more is the short of it.
Yeah. And I mean, this is today, but we've kind of seen that play out in other ways in the video gaming space where you had all these engines come out that made life easier for game creators, over the last decade. And what actually happened to the industry is it multiplied. The size of it just grew exponentially because you now could create more content. So more high-quality games were being made. More people were being employed in the industry. It didn't... As people to some extent worried back then, it didn't actually kill jobs. So I think that's 100% correct. And in many cases, you'll just see perhaps higher quality, more product, as opposed to one guy loses the job and it's mutually exclusive. It might not be that way. Yeah.
I think on the flip side of the bullish frenzy at the moment, there's also, I think exactly what you're saying, a number of companies, plenty of companies out there where they're being tarnished with a brush that your business is going to be obsolete because of artificial intelligence it's not easy. I think you really do need to determine whether the future is in doubt or not, but there's some interesting investing opportunities out there where people are just assuming that the business is going to become obsolete.
No, there are. We've been riding one that's up a good 40-50% here today, TaskUs. Low-cost outsourcing for high-tech companies, chat support and helping people navigate through issues, logging in and whatever else. And that was massively hammered as the AI hype started to bubble. But look, their revenue's inflecting back to growth, and I think you still need these things. It's dirt cheap, or was cheaper, I guess, a few weeks ago. And you do have these opportunities 100%. I mean, one that we were doing a lot of work on and closely pulling the trigger on is in the gaming space. was also seen as an AI loser, went down from 30 times earnings to 12. And lo and behold, 75% offer from private equity came over the weekend. And you can bet your bottom dollar that these guys hired a lot of industry experts to kick the tires. I wasn't private equity. I mean, you spend a lot of time and money doing diligence on the operations and resilience of the business, at least on a 5 to 8 year view, right? Your holding period. And they came, I suspect, to the same conclusion that we did. This is actually not that detrimental. There's parts of the business that will benefit. There are some parts that will lose, but net, this is still a cracking business. And I think there are still opportunities out there that are painted with that brush, And equally on the other side, there's 100% things that have run really far. There's some crazy stocks in the US trading at hundreds of multiples of PE just because there's some sort of AI link or ties to whatever.
What was I think that was
spectrum.
Percentage of companies that mentioned AI in their earnings call.
Oh yeah,
I said that. 5%?
It was exponential growth.
It's up to something like 40.
Well, yeah, when you have a copper miner telling you how AI is going to make their mines more efficient, and I'm sure it will, but I'm sure that software was already there 5 years ago, 10 years ago. Anyway, I know that the mine optimization software has been around for ages, right? We've covered the industry for a while.
But now they're just global, so
well, exactly. And now they're just putting the AI label in front of it and using the buzzwords. So it's hilarious to see. And again, we've been through this many times across various topics and things.
And if you're the miner and everyone else is going to have the same technology, it's going to end up in whatever efficiencies you get will ultimately be passed on to the price. We might move on to some commodities chat, but before we do, it's supposed to be a whiskey podcast here, Harvey, and you haven't mentioned a whiskey yet. I think we've both been working pretty hard. We had a birthday party for my wife recently, and she was gifted a couple of bottles of whiskey that had her name written on them. So you can do this through Archie Rose.
Right.
Really, really cool idea. You get a bottle of whiskey and it's got your name on it and the year that you got it. The Archie Rose whiskey, it's another one of these. We're going to sell you, I don't even know, they don't tell you how old it is, but 6 and 7 year old whiskey. They claim that the whole age thing's a bit of a furphy, but for me, I think you can taste the lack of softness in the newer
Is it
whiskeys.
Scott? Where are they?
That's an Australian.
Well, it's interesting. I mean, if you go on a tour of Manly Spirits, they will tell you why in Australia you can do what Scotland does in 12 to 15 years in 4 or 5.
Yeah.
And it's the humidity and the temperature.
Yeah.
That
it also means they don't have to hold
process.
inventory for 10 years.
It's actually, it's better to be you might not get the premium yet, but it's definitely better to be an Aussie whiskey producer from a inventory and working capital perspective than a Scottish one, I can tell you that. But that's an interesting tour. Well, actually, I think we should get a nice Coastal Stone whiskey from Manly Spirits, given it's up here, and I think a lot of listeners can easily pop up to the brewery, go through the process of how they make it, and have some cracking whiskey that's made in very limited supplies that you can only get them in certain places. So let's tee that up for next time, I think.
Sounds great. She got a Nant one that was the same, actually, a better whiskey from my perspective. Very tasty one, but really great gift idea, I thought, for someone that likes their whiskey. Get a bottle with a name on it. Yep. Super idea.
Stay tuned. We'll be back in just a sec. Are you a long-term investor with a passion for unloved bargains? So are we. Forager Funds is a contemporary value fund manager with a proven track record for finding opportunities in unlikely places. Through our Australian and international shares funds, investors have access to small and mid-sized investments not accessible to many fund managers, in businesses that many investors likely haven't heard of. We have serious skin in the game too, meaning we invest right alongside our investors. For more information about our investments, visit foragerfunds.com. And if you like what you're hearing and what we're drinking, please like, subscribe, and pass it on. Thanks for tuning in. Now, back to the chat.
Well, you touched on copper a second ago. It's been something that you and I have, I think, mentioned on the podcast before, certainly written about in the reports.
Yep.
I'd say I feel like the returns on capital in the commodity space are going to be higher than they have been historically, due to ESG and a number of other factors across the board. But we've been particularly interested in the copper story. It's historically just been a good proxy for the economy, but good reasons, I think, for that unlocking. You've had both copper and gold hitting highs recently, fairly strong
multi-year highs.
Year.
Yeah, that's right. Copper's up 25% just over the past 2.5 months or so. We've owned Glencore for a while for exposure there. We're constantly screening for other names. I mean, they have re-rated the pure play copper companies to some extent, but there's a good reason why. You have a multi-year story here in the demand side, and if you think about it, the new economy, quote unquote, that the world's trying to transition to, they need a lot of copper. EVs, charging stations, data centers, grid capacity expansions, all that jazz. You just need it. And it's hard to see where the supply is coming from at the moment because nobody's really investing CapEx. That was years ago already and still kind of hovering at lower levels versus history and certainly versus GDP and so forth. And ore grades of existing mines keep getting worse. It feels like every few months there's some sort of mine disruption in some part of the world, particularly in emerging markets and so forth. So I think investors, traders, mining executives for a multiple number of years now have warned that the world's going to face a critical shortfall of copper. The green industries just are gobbling this up and they need it. And yet, it's on the other side, you've got some inventory build in certain places people are concerned about and a slowing China, which is a decent user of copper, particularly in construction, buildings and so forth, wires and whatnot. That's kind of kept a lid in it and it looks like it's finally starting to erupt, for lack of better words.
Yeah,
So,
I'm seeing it mentioned more and more, but I do think the whole India demand story is really starting to move the dial across all of these commodities. I've been quite worried about Chinese demand, whether it's coal or iron ore or copper. That economy has been on an unsustainable path for some time, but what's going on behind the scenes here is the Indian economy is growing very quickly, finally, and there's lots of negative stuff written about the PM over there, but I think it's almost required a strongman type approach to get that economy going in the direction that it needed to go in. And it's become a genuine powerhouse and there is a lot of infrastructure build going on there and there is an enormous amount that needs to happen over the next 20 years. So it has really become a demand engine and possibly made me less concerned here about the impact that China coming off the boil is going to have on some of these markets. It's another China in the making in India.
Yeah. And I think we're generally positive about the wider commodity space for the same reason. And we've touched upon kind of the energy side of things at the beginning of this podcast. So there are multiple drivers. You don't need all of them to turn on for demand to go up, if that makes sense.
Yeah.
You just need some of them to still be there in 3 years, 4 years' time and so forth. So.
Yeah. And the supply side, it's just not going to get any easier to develop a new mine or even add capacity to an existing one. And maybe rightfully so, there's a lot more constraints on where and what people can do, but to the extent that we want all of these new technologies and want to drive electric vehicles, it's going to need to be found somewhere. And I think it's just going to require higher returns on capital and the cost of these things is going up as well. And that means that if you own an existing reasonably low cost asset, you're going to be sitting on a very, very profitable literal gold mine in some cases, but gold and copper together.
100%.
The market's been a bit like that this year, so far this calendar year even, Harvey. It was a very, I think, narrow range of better quality stocks into Christmas and January that were driving the market. But there's more going on out there now. I think there's other things that have been leading the market more recently, including a fairly strong commodities recovery recently. European financials, we've talked about that on the podcast with Gareth, a sector that people hated for 15 years. I think you were saying the best performing. Yeah,
as of, I think, this weekend, it was the best performing index in Europe, the Banks and Financials Index. So that's amazing. I think if you ask most people, they probably wouldn't think that, but it has been. And it's funny that the rally is certainly broadened. And that's good to see. I think it's healthier than just certain pockets getting overextended. But we're still finding some really interesting opportunities. There's a bunch of sectors that are still, I think, in the doldrums. Consumer discretionary still has a lot of opportunities. There's still a lot of opportunities in certain commodities. Solar's gotten beaten to a pulp. That's went from being the hottest thing on the face of the planet to trading at multi-year low multiples. A lot of the solar kind of component manufacturers and whatnot. And I'm not even talking about the commoditized things like the panels where China's dumping and whatnot, which the US, by the way, said they're going to put tariffs on now, which is interesting.
Haven't you heard Australia's going to be a global powerhouse in solar manufacturing?
So I think there's still pockets of opportunities there. And I think this kind of stock I briefly mentioned that was seen as a quote unquote AI loser, but has a cracking 20-year record and just really good business. Just got a 75% takeover offer. So there's definitely still stuff out there. And I think if you look across countries as well, US and the NASDAQ certainly have re-rated to higher multiples, but you still, you look at the UK on the other hand, and still trading at very reasonable valuations, and parts of Europe as well. So there's definitely opportunities out there.
And I feel like there's a fragility to it, or there's still a lot of fear about those things that haven't worked for the past decade, whether that's financials or even here in Australia, the small cap end of the market. We had Gentrack out yesterday with a profit upgrade. That share price is up 5 or 6-fold over the past couple of years. Any business that's downgraded, we've got a couple of tourism-related stocks where the share price has halved over the course of the past 6 months as well. On their downgrades, but they cut the value of your business here by 5 or 10%, and the share price has halved. And I didn't think they were stupidly priced to start with. So nobody wants to be left holding any business that's disappointing, or there's a certain momentum aspect to this, that if you get on the wrong side of it, it's still share prices halving here, rather than your normal sort of bull market environment where everything is just up no matter what they do.
No, definitely. I think it is very momentum driven, and it reminds me of a quote from someone that me and you both know. I won't say his name, but one of my favorite salesperson people out there. Big moves start with big moves. And I think we've seen that year to date with some of our investments. I think Zeta comes to mind, where the company's been beating and raising since we've owned it for 2.5 years, and the stock's not done very much. And then all of a sudden they do it one more quarter, which was in Q1, and lo and behold, it's doubled year to date. We still think it's an unattractive multiple. It's just that you've had all of this earnings growth over 3 years compound, and you've had all these beats and raises compound, and the stock did nothing. And then all of a sudden, wham, goes up a lot in earnings, and then just continues. And it's been up, I think, every single day almost for the past 3 weeks. So, sometimes it comes later. You don't want to be missing that in things you own either.
Yeah.
But it is momentum driven. And once this started, it's continued. You don't want to overstay your welcome. So I think it's very important to be disciplined. It's certainly a momentum driven market at the moment. I mean, not that it hasn't been for many years now, I suppose.
It's actually a really interesting topic, and maybe one for another conversation, but something Alex Shevelev talks about a lot is this understanding what type of business that you own, in terms of whether you should let some of those things run more or less. And this idea that a business can be an open-ended growing business where it might be perceived differently by people down the track, versus one that is just, this is not the world's greatest business. I bought it at a stupidly low price. I need to sell it at what's probably still a low price as well. But, a stock like Zeta, there was plenty of skepticism, and even internally we're asking plenty of questions about whether they were going to deliver on the promises that they had made to people. So it's okay, they beat once, I'm still skeptical twice. It's been 6 of them, right? But you get to the point where even I go, well, that concern that I had has gone away, and therefore instead of it being a 10 or 12 risk-adjusted multiple that you think is the right number for that business, it can actually be a 20 or a 25 or even a 30 if the business is going to keep growing. And that's what's happened with Gentrack as well, that you've had earning growth, and because of the confidence that growth is going to continue, you've had the multiple of the business go from 12 times.
They usually come hand in hand, and that's when you get the multi-baggers, right?
In that case, it's 50 times 2 years out earnings now, because everyone's climbing over themselves to own the stock. So I think that is an important thing that we've really tried to incorporate into our portfolio management skills over the past few years, is be aware to the different perception that this stock might have about it if the investment thesis goes to plan.
100%.
If it's Seven West Media, it's shrinking, everyone knows it's going to shrink. It's never going to be perceived as anything different to that. You need to be aware of that, and you need to be willing to sell those businesses at what seem like still cheap prices. Yeah. If it's a business that people are potentially going to be willing to put a higher multiple on, it doesn't mean it is going to happen, but as that probability goes up over time, you need to give them a bit more runway. I
agree. I've always been a fan of letting things run. You manage the position size. Don't let it get crazy and be a huge chunk of the portfolio because it's multi-bagged, but you let things run until the thesis breaks, or the company has a bad miss, or something like that happens, right? I mean, obviously, if it gets to a really ridiculous multiple, you better step back and hope for a better opportunity. We had that with Celsius a few times. I think we bought it back, 2-3 times. I managed to double our money each time. So things do always get ahead of themselves as well. So, but generally, I totally agree. And perception is everything to some extent. Market is inefficient, we think. So just being a step ahead there and letting others put their perception onto the stock price is sometimes a good thing.
Put yourself in someone else's shoes and say, how would this particular type of investor, if that stock has now become appealing to them, think about this, rather than us with our cash flow based we want to earn 12% per annum here, right?
Yeah.
It's just can be as simple as these people think 7 and 8 is the right number for the right sort of business.
Yeah.
Okay, everyone, thank you for tuning in. Harvey, thanks for your time again. You in the country for a while, or are you heading off anywhere soon?
I'm here for the time being. I got a conference later this year in the US again, kicking the tires on a few things. But yeah, here otherwise.
Enjoy being home for a while. You spend a lot of time on the road, so it's good to have you around. Thanks for tuning in. Any questions, send them through to admin@foragerfunds.com. And thank you for your support. Don't forget to share the podcast and like it on whatever podcast app you use.
Thank you.